Bismillah Rahman Rahim. Hussain Qazi here. A very warm welcome to my SBR session. The agenda of this session is a debriefing session. It's about a debriefing session. Content, section B type question. Question name, Hebers company. Hebers company. Important thing is that I'm assuming that you people have already attempted this question before with exam condition. If you haven't done that, first of all, stop this video, attempt the question with exam condition, and after that watch this video and get the 100% benefit. So let's start. Examiner examine with section B, 25 marks, 2 questions. So here, one of the question that's called Hebers company. So always start question by reading the main content. That's a background of question, the background information of the question. As I have already told you before that, with this basic information, the background information, examiner set the tone of the question. And as a student, you just read it and develop your mindset about the question. Here, the highlighted point is that Hebers company develops AI solutions for use in healthcare industry. So if the company involves with the development of AI, so this is about something IS 38. That's related to 38. So first thing with your mindset, okay, with this question, I will face the multi-standard issues, including something, the development aspects, IS 38. Very important noticeable matter, that's reporting date, that's here, 30th June next year. Okay, so exhibits detail, number 1. First thing mentioned, project diagnose information relating to ongoing development project. Okay, development project. Number 2, bank loans, financial liability borrowings, details of renegotiating of loan from Crown Bank. Okay. So IS 38, IFRS 9, service contract with Gill Health, details of the contract with Gill Health for health services. That is something about service contract. It's not 100% clear what is exactly about, but we will discuss with the main content. Medico AI provides information relating to Hebers company plan to set up a separate legal entity. That's something about investment with milk company and spicy company. Okay, wherein next to the reading of background, read the requirement. Quickly read the requirement. Number 1, part A, discuss following accounting issues relating to Hebers company financial statement for the year end 30th June next year according to IFRS. First one, how cost associated with project diagnose should be accounted for. Okay. The effect of number 2, the effect of renegotiating of bank loan on financial statement. Number 3, whether transaction with Gill Health is required to disclose in financial statement. So this is about something, third point, transaction disclosure. Part B, how investment in Medico should be accounted for in consolidated financial statement of Hebers company, considering each of 2 potential voting thresholds. 7 marks. Specifically mentioned 2 potential voting thresholds. 7 marks. Students, here one important point to notice. With section B, it's very clear, examiner examine multi-accounting standard issues, including accounting standards, but including the group accounts as well. Examiner can examine accounting standard, conceptual framework, number 2, performance measurement, investor perspective. Number 3, current development, but not the ethics, because ethics placement with section A, question number 2, 20 marks. So first point, multi-standard and multi-topical issues with section B type questions. Second important point to noticeable, examiner with any one question of section B will examine the investor perspective as well. If examiner examine the investor perspective type question, so here particularly mention the professional marks, for professional 2 marks. Whenever examiner examine the investor perspective, so mention professional 2 marks. Here the question not includes the professional 2 marks. That means no requirement with respect to the investor. No requirement with respect to the investor. So this is a topic, this is a question with multi-topic about accounting standard issues. Maybe the conceptual framework. It's something about current developments. So ignore the current development aspect. So here, standards or maybe the conceptual framework. By the way, here with this question, there is no requirement about the conceptual framework. It's specifically about multi-accounting standard, including group accounts issues. Okay, so let's start the reading of the main context. Okay, one more important point before reading the complete question. There are 2 possible approaches to attempt the section B type question. First approach is that read the complete question and then start planning an execution or drafting your answer or attempting your answer one by one. So approach 1, read complete question and then attempt the requirement one by one. Second approach is that read exhibit 1, then plan it accordingly with the brainstorming and attempt the exhibit 1. Then read exhibit 2, plan it and including brainstorm the things and then attempt exhibit 2. Then 3, then 4. This second approach, it's more appropriate, it's much smarter. You can save your time accordingly. Majority time, the exhibits are not interrelated because requirement are also, it's very independent. So you can just read one by one exhibits and then execute your answer. But before execution, you have to make a good plan and brainstorm. Good plan including brainstorm. Okay, so we will move with this question with one by one exhibit. Approach number 2. Let's start. Come on. On 1st January X5, by the way, your year end is 30th June X8. Okay. 1st January X5, Hebers company commenced the project to develop AI for use in diagnosis of medical conditions. Project Diagnose was expected to complete an AI product successfully launched to market by 31st December X9. So that's a background, it's the history of this development. That was started 1st January X5 and expected to complete by after this year, that 31st December X9. The project progressed well and all project cost incurred to date. So now the question, it's moving towards something research and development aspects, where we need to filter out which cost to expense out, which cost to capitalize, and blah 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 blah. The project progressed well and all project costs incurred to date, including admin overhead, employee benefit, depreciation of dedicated IT equipment, were recognized as asset on 18th of July 7. 18th of July 7, it's a mid of the year. When the recognition criteria of 38 were all met. Here the recognition criteria met. But there is a concern point. IS 38 development cost criteria is that if the criteria met, you can capitalize the cost. But which cost to capitalize? Employee benefit allowed, depreciation of dedicated equipment allowed, but general overhead, it's not allowed. So here is the mistake about the admin overhead. This should be charged. That should be charged to the P&L. Okay. Further, cost incurred since this date have increased the carrying amount of the asset. In October X7, once again, this is the mid of the year, a competitor's breakthrough caused Hebers company to reassess position. Whatever the asset capitalized, now need to reassess the future benefits because the circumstances has become changed due to some external factor, some impairment issues are, and the available market. Reassess position and the market. Assess the company's position, assess the market position. It decided to progress its project, but to redefine the objective and extend its term to 2 years. By 2 years. If we stand at 30th June X8, and originally we were expecting to complete by 31st December X9, so that means originally we were expecting that project will complete after 1.5 years. But now the position has changed and they wanted to extend by 2 years. That is the point. So here examiner asks you, once again, read the requirement. How costs associated with projects should be accounted for. So now, before start to draft anything, first of all, make a good plan. Plan includes, we have read the question with a clear understanding of requirement and the content. Number one. Number two, now before drafting, it's time to organize your point. That's what you will write. This is a 7 marks question. So how can we plan our question? I always advise to my students that always start with a very basic and a simple statement. And you can start here a very basic reference of IS 38, intangible asset research and development. Very basic. That's 2 marks. Very basic. About the research and development. And very categorically mention about the directly attributable cost that's need to categorize. That's need to capitalize. So basic structure of research and development, which to capitalize, is not to capitalize. Then with respect to development, which are the costs that need to capitalize, which is not possible to capitalize. Then you move towards the application part. That's, you have to mention that write off the cost that's ineligible to capitalize P&L. That's the costs which are not eligible to capitalize, charge to P&L. Then make a reference of impairment. Put a basic reference of the impairment, then apply with the case. So you can draft your answer with these classification of the marks. So now come on. Very basic. First, development project. development project falls within the scope of IS 38. Not necessary to mention the complete name. Falls within the scope of IS 38. And the company Hebers recognize all project costs incurred to date as an asset on 18 July 7 if the 38 criteria were met. And of course, here the criteria already have met. All costs incurred prior to recognition must be expense that is about the research or the development not able to meet the criteria, that were not able to meet criteria. In this case, during development phase, criteria do not meet, all previous costs immediately charged P&L. And 38 does not allow the retrospectively adjustment. Retrospectively means if some of the costs not able to meet the criteria and you have already capitalized, so you need to charge immediately to the profit and loss account. That's the first point. So first point about the 38 criteria and get easy 2 marks. Then application about here 1 mark. 38 clearly mentioned the cost to be recognized asset development cost only directly attributable. Only directly attributable. This include employee benefit relating to staff working, staff working directly attributable to the project, and the depreciation of the dedicated property plant equipment. But it does not include the general admin head. So what do you need to mention? Herbs should remove any cost that's not directly attributable to the project and expense to the profit and loss. So knowledge and application. Yes, of course. Here's something about impairment test. So IS 36 particularly mention about intangible assets that is not available to use for tested for impairment before the year end. Some of the development costs which is not available for use, not available for tested. So impairment tests must be carried out before 30th June next year. If some indicator arises, and here the indicator has arisen, Herbs has redefined its project objective, it's mentioned in the question, as a result of competitors' breakthrough, which suggests that this had an adverse effect on Hebers. And this appears an indicator of impairment, and Hebers should have tested the capitalized development cost of the impairment in October X7. That's a point. If asset is impaired, the result, so number one, it's settled that yes, we need to make impairment test. First, draft answer about the impairment test. Why here need to impairment test? Next point, if asset is impaired, so loss should be write off the carrying amount of asset and charge to profit and loss. What I personally suggest with this question, this detail of IS 36, you can skip. Directly mention that the redefined its project object as a result of competitor breakthrough is an indicator of impairment, and this development cost, although it's not completed yet, need to assess the impairment test because the indicator has arisen. And if the impairment loss arise, then you need to mention the right of the carrying amount. Right of the carrying amount of the development cost and charge to the profit and loss. So this is what about the first part, A1. Now move for the next part. First exhibit done, then the next part. The next part is about bank loan. Bank loan. If you have already attempted the question, you have realized that this is something, the modification of the loan. Modification of the loan. Okay, 1st January X5, 1st January X5. First, our year end 30th June X8. So some years ago, 1st January X5, Hebers company obtained 15 million loan from Crown Bank to finance the development of AI for the use in diagnosis of medical conditions. This is a financial liability, bank loan. The loan agreement required annual interest payment arrears at 6% on the term loan. This 6% is effective interest rate. Effective interest rate of the original loan. Don't forget that. And the repayment of the loan on 31st December X9. Originally 15 million loan. Originally redemption date 31st December X9. Original effective interest rate 6%. As a consequence of extension of project with Exhibit 1, whatever the reference with Exhibit 1, Hebers company commenced negotiation to amend the loan of the bank in October X7. 1st January X8, 2 years extension to 31st December X1 was agreed with interest rate for remaining 2 years, with the interest rate of the remaining terms reduced to 4.5%. This is a new rate. This is a new rate. This is a new rate. Payable annually in arrears. Students, this is modification of loan. This is modification of loan. This is modification of loan. And IFRS 9 new requirement of the modification loan, it's very clear to make a test of substantive modification or not. Either the modification is very substantial or not with the 10% threshold criteria. If the modification qualify the substantial criteria, that means the modification is about more than 10%. So the treatment is called extinguish, modification with extinguishment. Extinguish the previous liability and recognize the new liability. If the modification it's under 10% threshold, so here the adjustment called modification adjustment. Only previous loan need to adjust, that's all. That's a new requirement of the IFRS 9. So first of all, brainstorm. Brainstorm. IFRS 9. Very basic. I always suggest to my students, always start with the basics. Although it's a modification, but don't start immediate with the modification because the topic is about financial liability. So start with initial recognition and take very easy 1 mark. 1 mark. Initial classification and measurement. First, how to recognize the financial liability. Here about the initial recognition measurement about the financial liability. So bank loans as a financial liability initially designate at amortized cost method. Initial recognize and measurement or designate at amortized cost method. First, and initial statement it's about before modification, because modification actually arise with this year. No? You originally have taken the loan, this company have taken the loan with the previous years. So what we have done previous years, recognize as financial liability amortized cost method, and then explain the subsequent of the amortized cost method. Very basic. Then after that, take simple 1 mark. Then start with modification. Very simple. First explain the meaning of modification. That's called renegotiating or negotiating the bank loan. And then start the assessment criteria. Assessment criteria based on substantial. Need to determine either substantial or no. Let's get the 1 mark. Just mention how to assess substantial. That's a 10% threshold criteria. These 2 marks is exactly about the basic knowledge and little bit application by reference of the case. Yes. Then enter with the accounting treatment. That's what the accounting treatment. Same basic knowledge. What the basic accounting treatments about modification with extinguish or simple modification. So 1, 2, 3 marks is a basic knowledge. Then start the calculations. The carrying amount at modification date, the carrying amount of the original loan, and the calculation of the negotiated loan, and compare the carrying amount with the negotiated loan. So here you need to apply whatever the knowledge you provide with this part, then apply with this. That's calculation, description, 2 marks. And finally, what should be the reporting amount at the end of the day. So that is the point. So let's start. Very basic point, students, very basic point. First, get 2 marks, simple. That's IFRS 9, financial liability, classification and measurement. Number 1, bank loans, financial liability, measured amortized cost. Very simple. Initially, 1st January X5, that's 15 million. Then each year the finance cost, that's the first year, the finance, this is 6%. So 1st January X5, the 15 million. The 15 million. The finance cost 450,000 should have been recognized in the year 30th June X5 because it's a 6 months. 1st January X5 to year end 30th June X5. That's 6 months. If you calculate the 15 million multiply by 6% into 6 over 12. 6 over 12. So that's 900,000. And 30th June X7, X6 and X7. It's a complete 6%. That is no apportionment. 900,000. It's very simple. Initial measurement with amortized cost. Now start modification. Modification explain the meaning and explain the assessment. Modification of loan arises when if the term of existing loan, the existing financial liability are changed, or if existing loan is exchanged. The scope of modification is about the change, or it's about exchange. Change of the existing loan or exchange of the existing loan for a new loan with the existing lender. So modification means the loan change in the existing loan or exchange of the existing loan with the existing lenders. 31st December X7, that loan it's become renegotiated. In this case, Hebers must assess whether this is a substantial modification. How to know about the substantial? That is about the 10%. If discounted cash flow under new terms, including the new fees payments of the during negotiations, new transaction costs, if the discounted cash flows, future cash flows, and the transaction cost of the new loan, it's 10% different from the existing carrying amount of the loan. Existing means discounted remaining cash flows of the existing liability. So that is if it's 10%, if the change is about 10%, that's called substantial. And do remember, for all these calculations, we always use original effective rate. Original effective rate, original effective rate, original effective rate is 6%. If we calculate the change, how to calculate the carrying amount of the previous loan with amortized cost method at modification date versus the discounted cash flow of the new terms of the loan, including the fees. If the difference is more than 10%, that's called substantial. If less than 10%, it's called less substantial. Or it's, if substantial, we will account for as extinguish accounting. If it's not substantial, we will account for as modification accounting. But whenever you calculate the discounted of remaining, either the discount of remaining cash flow or the discount cash flow with the new terms, always use the original effective rate. Always use original effective interest rate. Don't use new effective rate of the modification. Here in our case, we will use this 6% effective interest rate. We will use this 6%. That's important. Okay, accounting treatment. Knowledge. If the modification is substantial, so it's called extinguish accounting, which means you need to de-recognize the existing liability. Extinguish accounting means de-recognize the existing liability and debit the existing liability, credit the new liability. Credit the new liability. So debit previous liability, old liability, credit new liability. Always credit new liability at its fair value. And any difference in charge to the P&L. If modification is not substantial, the existing liability is continued to recognize, not to de-recognize, continue to recognize, but the liability is restated to the present value of revised cash flow with any fees paying, with any fees. Fees means transaction cost, that's need to be deducted. Like original amortized cost liability, when you originally recognize the liability at amortized cost, you deduct the transaction cost as financial liability, so that transaction cost will be amortized over the period. Same here. No need to de-recognize the previous liability. Whatever the change has made, you need to incorporate with the new liability if required. You have to incorporate a change with the previous liability if required. and minus the transaction cost, and then move on accordingly. In any of the case, if there is any difference, you need to charge to the profit and loss. Now it's time to apply 10% test with this scenario. So first important thing, what to do? We need to compare carrying amount of the loan at modification date versus new negotiation of the loan. So carrying amount at present value, new negotiated loan at present value. But before that, very simple. Here the carrying amount, it's very simple. It's a bank loan. Originally, as discussed earlier, originally we recognized the loan 15 million. Opening, ending, always the bank loan reported at the 15 million. Our loan negotiation time at 1st January exceed. This is the time. 1st January exceed. That's the time. 1st January exceed. 1st January exceed. At this time, the loan carrying amount is 15 million. Now, whatever the new value of the modified loan, either increase or decrease. First thing is that what's the threshold? What the threshold to compare the modification is substantial or not? The threshold is 10% of this 15 million. That is 1.5. So whatever the new value we will calculate, after the calculation of the new value, we will evaluate that. Is the change, is the difference, it's more than 1.5, it's less than 1.5. If it's more than 1.5, it's called substantial modification. Substantial, yes. If less than 1.5 million, it's less substantial. If it's equal to 10% or more than 10%, it becomes substantial. If it's less than 10%, that is not substantial. Now it's time to calculate new loan. Listen carefully about the new loan. Originally, the loan recognized 1st January X5 and the original redemption date that was decided 31st December X9. 5, 6, 7, 8, 9. 5, 6, 7, 8, 9, 5 years. Now are standing at 1st January X8. Do remember our year end 30th June X8. But during the year 1st January X8, loan has now become negotiated. Means 5, 6, 7. After 3 years from 1st January X5, after 3 years at 1st January X8, loan now become renegotiated. And with the renegotiated term, the new revised life, it's 1st January X8 to 31st December X1. So X8 year 1, X9 year 2, Y0 year 3, Y1 year 4. So with the new negotiated, the remaining time 4 years. Number 1. With the new interest rate 4.5%. Lower interest rate, because here the Hebers company not able to pay. Okay, revised interest rate. But do remember, new modified loan present value will calculate with the effective interest rate of this original 6%. Discount rate will use original 6%. That we have already discussed. Now come on. It's the time for working. Year 1, X8, year 2, year 3, year 4. 1, 2, 3, 4. Cash flow 675. How 675? 15 million multiplied by 4.5%. that is 675. Sorry. 675, 675, 675, and finally 15,000, that's principal, and 675. Discount rate original 6%, and your revised value is 14.22. So here's the calculation of the revised loan. Now here the loan present values become reduced, not increased. Now compare 15 versus 14.22. The difference is 0.78. This 0.78 is under 1.5. 1.5 is under 10% or less than 10%. So that means modification is not substantial. That's not substantial. It's very clear. So first here the 2 marks to justify here the substantial or not. Now the final point, if it's not substantial, so how to account for the things? Do remember here modification arise during the year, at the mid of the year. So first 6 months the interest cost will recognize with the previous version of the amortized cost, and last 6 months with the new rate, that is 4%, 4.5%. Okay, this is about interest cost. What about the loan? Previous loan not to de-recognize. Not to de-recognize. And if it's back out and the new loan, it's still to continue. It's still to continue. Sir, at what amount? Students, very important point. If the loan is something about the addition about extra payment, which is not the case here. Here it's not about to make a promise of extra payments. Here about, no, we will not pay the extra amount. In fact, we are reducing our interest. But yes, we will pay the same principal. That's a negotiation. Negotiation is about interest rate reduction, not the principal. So that means 15 million is continued to recognize. Once again, the previous loan not to de-recognize because it's not substantial. So that means original loan need to continue to recognize. Continue to recognize. That's important. But at what value? There are two possibilities. If there is increase in loan, no increase in not. It's not about increase in loan. It's about decrease in interest payment. But the principal is committed. So that means 15 million I have to pay that. So that's why there is no change of the previous liability, still to continue, and no change in value of previous liability, still to continue. The case may be different if something about to pay extra amount. That's not the case here. I'm not discussing here. So 15 million is still to continue. Number 2, what about the finance cost? First 6 months, 15 million. First 6 months. Multiply by original rate 6%, multiply by 6/12, and that's the amount 787,000. Remaining value, sorry, it's not 787, it's this bracket. Remaining 15 million multiply by 4.5% into 6/12. And the collective matter, the collective overall total collective matter equal to the collective point, this collective point equal to 787,500. 900 15 million for 6%, 6 over 12, 15 million for 4 over 5%, multiply by 6 over 12. That is about the case. And in fact, this part of the portion, it's not about the debriefing. In fact, the complete briefing. That's about. I hope it's very clear. It's if you have any confusion, you can ask me on the WhatsApp. Now, the exhibit 3. Now the exhibit 3. Now come on. During the year to 30th June 1988, Hebers company obtained services from Gill Health, a company controlled by the sister of MD, managing director of Hebers company, for $600,000. Okay. Gill Health is a company controlled by the sister of managing director. Managing director means key management personnel of Hebers need to assist either the sister for the close family member of key management person, that is managing director. And if sister of the key management person is a close family member, so the company controlled by sister, controlled by the sister of MD, that's Gill Health. It's a related party of Hebers. But the question is that, is the sister under the scope of the definition of close family member? It's not clearly mentioned with IS 24. We have to take some judgment here. If sister can influence the decision making of the can influence the decision making of the Hebers company through the key management person, so we can declare that it's a related party transaction and need to disclose. So here the answer is something required disclosure. The transaction which was negotiated on terms of arm's length. So what? Irrespectively, if the transaction is between related party, even though it's arm's length, we have to disclose. The transaction which were negotiated with arm's length was approved by board of directors. The managing director did not participate in the tendering process. That's good. And declared an interest in the transaction. Did not participate and did not declare any interest in the transaction. The question is that whether the transaction with a company Gill Health, which is controlled by the sister of the key management person, the MD, is required to disclose in the financial statement. So this is something about IS 24, which was not very much clear by reading requirement of the background information. But once we read the context of the question, read the exhibit of the question, we have identified it. That is 3 marks question about the related party. So number 1, how to draft my answer. Think about, you need to think in, you need to develop your mind. First start with the basic point. A very basic point. About related party transactions and close family members of key management person. Basic description about IS 24 about key management personnel and close family members. That's what's the meaning of key management person, what's the meaning of the close family member. A basic description for 1 mark, starting point. Then simultaneously apply the IS 24 issues with the case. MD's sister, is she considered as related party? Close family member of MD. If yes, then the entity controlled by MD's sister, the transaction with Gill Health, it's considered as related party. And of course, if we are applying judgment So we have to consider the materiality. Either this discussion is about the material transaction. If it's material, that's also emphasized to disclose as a related party transaction. That's a problem. Now come on. This is what about the solution? Very simple. Number one, under IS 24, MD's sister is related party to her Hebers if she meets the definition of close family member. Now you mentioned it. IS 24, close family member as family member who may be expected to influence or be influenced by that person in dealing with entity. If we read the definition of close family member, the specification of certain relationship, include spouse, dependents, all these things. If we consider the specification of certain relationship that meet the definition of close family member, example spouse, did not include the sibling. But this doesn't mean that here we exclude the siblings as close family members. The important point is that either siblings may expected or be influenced the person dealing with the entity. That's here the person means here the MD. Therefore, judgment is required to determine whether MD and sister have close relationship. Close relationship such that one would be expected to influence the other. In making this judgment, the fact that transaction was at arm's length may be relevant. Yes, this para is very important. If we really wanted to consider either the relationship are influenced with each other. So here the case about the transaction at arm's length means they are actually influenced with each other decisions. If this is the case, then the entity that's called Gill Health is also related to Hebers company because MD's sister controls that company. If Hebers conclude that this is a related party transaction, IS 24 requires details to be disclosed in the financial statement. You don't need to mention which details. Listen carefully. Here, the answer, especially last two lines, wordings are very, the wordings are with a conscious manner. It's a very cautious manner. It's very sensitive. Because the situation is not exactly 2 plus 2 is equal to 4. So, you need to draft your answer not in exact manner. Like this. If this is the case, apply some diplomacy. If this is the case, Gill Health also related to Hebers because MD's sister controls the company. If Hebers conclude using the word if, however, like use these type words. Don't, if any of the case, if you are applying the judgment, you need to conclude your answer with these type of statements. Not exactly, because the answer is not about 2 plus 2 is equal to 4. And with SBR answers, you will face a lot of things about this, like this. So always use the terminologies with some cautious approach. You don't need to mention that here we have concluded that Hebers should report the transaction at the related party. No, you have to use the judgment here. That's a point. Materiality, however, requirement of IFRS need not applied if the factoring of not applying is immaterial. Yes, the amount of transactions 600,000 may not be considered material by size, but transaction with related party are considered to be material by nature and disclosure is relevant to the user of the financial statement regardless of the amount involved or term of trade. If someone says that ignore this transaction, even this is related party because the amount is not material. So materiality is not only about the quantity, it's also about the nature of the discussion, nature of the transaction we are talking about. Here, the transaction with related party as a qualitative matter, it's important rather than quantitative. So that's why I need to disclose here. That's about this, the exhibit. That's over about, that's all complete about this part of exhibit. Now, sorry. Part B, very interesting. Part B. Part B. Exhibit number 4. Exhibit number 4. Read the context very carefully. Examiner examine group accounts matter with section B type questions as well. Hebers company has plans to establish a separate legal entity, Medico company, with 2 other unrelated companies, Mill company and Spicy company, for the delivery of cost-effective AI solution for healthcare in emerging markets. Mill company will hold 50% of the shares of Medico company. Hebers company will hold 30% and Spicy company will hold 20%. The 3 parties will enter into contractual arrangement to specify the level of votes required to make decision about relevant activities of Medico company. Okay. So the case is something about IFRS 11 and something, maybe something IS 28 as well. That is something about joint arrangement, something about associates, like this. There will either be 70 or 75%. Not exactly, either 70 or 75%. Is currently under discussion. They have not concluded that. Separate contractual arrangement will modify the feature of separate legal entity so that each investor has an interest in Medico's asset and each liable for a specified proportion. Liability for specified proportion. So number 1, you have to develop your mindset about and to brainstorm in your mind. This is about investment by Hebers in an entity called Medico AI, where the arrangement, it's maybe under IFRS 11, and I wanted to discuss with the IFRS 11 here. That is called joint arrangement. So I have to mention either this is joint arrangement or not. If it's joint arrangement, either with account for as a joint proportion or joint venture. That's accounting by joint proportion or, or joint venture. If it's not about the joint venture, it's not under the scope of IFRS 11 for some reason, not meeting the criteria of IFRS 11, then consider as IS 28 significant influence. Because here, one thing is very absolute. Hebers don't have absolute control. So we cannot start the thing about IS 27 or IFRS 3 business combination. So discussion is something about 20 investment in entity, investment equity. It's about IFRS 11 or IFRS or IS 28. Let's start. Yes, come on. Number 1. Yes, with this type of case, you need to read the before starting the brainstorming, you need to read the requirement and ask yourself, have I got understanding about the requirement, what the examiner expectation? Here examiner explain how investment Medico should account for in consolidated statement of financial position. Consolidated, considering each of the two potential voting rights. So that two potential voting rights. That means my answer must have two draft with two different headings. What will be the case in the case of 70%? What will be the case in the case of 75% voting rights? So need to distinguish, need to isolate our draft separately about 70% make a heading, 75%. Clear this. Also start working with the very basics about the IFRS 11, all these things. Then spread your discussion. What if the 70% voting rights? What if for 75%? Plus, here very much clear, you must be very much clear. Herbs has 50%. Other two party, it's having 30 plus 20. Okay, so let's start. Number one. First, we will start discussion with a simple wordings of joint arrangement, that is IFRS. What is joint arrangement? Basic start. Here the case about the separate legal entity and mention that joint arrangement where agreement made by the entity and having no single party as a control of the arrangement like this. And very particular, the voting aspect, the decision making voting aspects must need to decide. That's important. Number two, joint arrangement, then you need to mention about the meaning of joint control. Then here the case about the consent of 70%. So you need to mention that. The case is about 50 plus 20 plus 30. If they are considering that the unanimous consent they can get with the 70. So that means this is not clear. Because 70% can be made with two different parties, 50 plus 20, 50 plus 30. So this is not clear. So unanimous consent is not possible if the decision is made of the proportionate, which is not clear. The decision can be made by two ways, 50 plus 20 or 50 plus 30. It's not clear. But if it's about the 75%, the situation is very clear. The decision making can be made with 50 plus 30 only. It's possible that remaining 20% is a silent partner. Don't mention the word silent partner. It's just for the understanding. But the absolute point is that 50 plus 30. This is called unanimous consent. Now come on. So you need to draft answer in this structure. Joint arrangement, joint control, unanimous. For 70% it's not clear. So that means it's not a joint control. So we have to report it according to IS 28. Herbs reported as according to IS 28. With a 75%, yes, it's a joint control. But again, the discussion is about either should account for as a joint venture or joint operation. Although it's a separate legal entity, but here the investor having a right over assets and liability, it's mentioned in the question, assets and liability, not the net asset of the entity. So that means although the separate legal entity, but it's a joint operation. And the accounting of the joint operation with individual books and the consolidation books, it's a joint it's a proportional consolidation. That's a point. So that's all about the debriefing of this part of the exhibit as well. But now we need to drill down the things. Number one, joint arrangement, very simple. Here, three companies plan to establish a separate legal entity, three entities. in which they hold different proportion of shares and no single party has control of the arrangement. Simple. Separate legal entity and no single party control the arrangement. If the arrangement gives two or more parties joint control, if meets the definition of joint control, this is joint arrangement and under the scope of IFRS 11. Basic statement. Now you need to explain here the joint control. Joint control exists where they have made contract, they have done it, and they have contractually agreed sharing of control about the decision of the relevant activities required unanimous consent. Very clear statement, very clear. In this case, there is a contractual arrangement, yes, but it is unclear whether such decision will require unanimous consent. If you feel that it's important or you have a time, then you mention this paragraph or the unanimous consent. Otherwise, you can skip it. Unanimous consent means all parties with joint control agree in order for decision making relating to relevant activities to be made, and no party can prevent any of the other from making unilateral decision with its consent. This is the definition. It's not necessary to mention this. But first 2 points, joint arrangement, joint control, and the case the unanimous consent is not clear, it's very important and get 2 marks. Now you need to split your answer in this way. For 70% threshold, if the threshold for decision making is about 70%, the 3 investors, investing company, collectively control arrangement, but more than one combination of parties that can agree to achieve. Million is spicy, million Hebers. 50 plus 20, 50 plus 20, 30. Therefore, there is a confusion. There is no clarity. So, if it's not clarity, this is not called unanimous. There is no joint control in Medico AI, and the Medico AI is not a joint venture. If no joint control, that no unanimous consent, no joint control. No joint control means it's not under the scope of IFRS 11 joint arrangement. So how to account for this investment by Hebers? Each investor, that here Hebers as well, would need to determine whether it has significant influence over Medico, in which case it would equity account for investment according to IS 28. Hebers hold 30% of share of AI, Medico AI. I'm sorry. Here Hebers hold 30%. I'm sorry, not the 50%. No worries about that. It's not affected the overall answer. 30% share in Medico, and IS 28 therefore presumes significant influence exists unless evidence to the contrary. So we don't know here the significance influence exists or not. If the significant influence is not clear, then apply IFRS 9 fair value account. So number 1, if significant influence do exist, so consolidated statement of financial statement would initially recognize initial investment at cost and subsequently recognize 30% of the total comprehensive income. That's called equity accounting. If you mention just the term equity accounting, it would be clear. Because here you will not have enough time, or in fact there's not so much marks to draft now, only 3 marks. You just mention the term equity accounting rather to explain the complete with the equity accounting. So assuming you can mention that assuming that significant influence does exist, so in consolidation Hebers use the equity accounting. If not the significant influence, the investment will be classified as financial asset, and IFRS 9 would apply investment carried at fair value, either P&L or OCI. Number 2, if the voting threshold is 75%, Mill and Herbs would join control over Medicos because voting together is the only combination of the party that could control decision. That's you have already covered above. Huh? You can mention directly. IFRS 11 apply as joint arrangement, must be classified as joint venture or joint operations. Now you need to distinguish here. When joint venture, when joint operation. A joint venture exists where investors have right over net assets of the joint arrangement. Where a joint operation exists where investor has right over assets and obligation, as the case here. Rights to the asset and obligation of liability of arrangement. The contract to modify the feature of Medico AI means investor has right to assets and liabilities of the entity and therefore is a joint operations. Therefore, in consolidated financial statement, Herbs would recognize share of assets and liabilities, income, expense, line by line with proportionate method to reflect the details of joint operation agreement. That's a, that is the point. So, in fact, I've started this session as a debriefing, but I've discussed the complete scenario. In fact, I've drilled down all the things. If you have any confusion, you can ask me. So, thank you very much about this part of the session. Assalamu alaikum.